Here's something that should make you uncomfortable. Lebanon, 2019. People woke up one morning, walked to their bank, and were told they couldn't access their own money. Not criminals, not people who did anything wrong. Doctors, engineers, retirees, gone. And the part most financial media won't say out loud is that this wasn't an anomaly. It was a pattern. A pattern that has repeated across every major civilization for the last 2,000 years. Victor, you've studied these cycles at an institutional level, so let's just start there. What is the single earliest warning sign that ordinary people almost always miss before a currency or financial system starts to crack?
Well, the sign is almost never dramatic. That's what makes it dangerous. It usually starts with a slow, quiet erosion of purchasing power that governments explain away with very reasonable-sounding language. The Byzantine Empire didn't announce they were debasing the solidus. They just adjusted the gold content, slightly, then slightly again. And merchants noticed before citizens did, because merchants deal in real exchange every day. So the earliest signal is almost always this: when the gap between what official data says and what things actually cost in daily life starts widening in a way that can't be explained by normal economic cycles.
So wait, you're saying the signal isn't a crash, it's a quiet mismatch. The number on paper doesn't match the number at the grocery store.
Exactly. And by the time most people name it, they're already behind. The Byzantine solidus was trusted for centuries, across Europe, the Middle East, Asia, and then it wasn't. Not because of one event, because of accumulated small betrayals of trust. And here's the thing I want to come back to, because it ties into something the bond market is showing us right now that I think is being almost completely ignored.
Hold that. We're coming back to that. Because I want to push on the Rome parallel first. Because critics will say, and I've heard this, that modern institutions, deposit insurance, central bank tools, Federal Reserve backstops, make a Byzantine-style slow collapse essentially impossible in the U.S. today. How do you respond to that?
I respond by pointing to Lebanon, because Lebanon had a central bank. Lebanon had a banking sector that looked, by regional standards, sophisticated. And none of it mattered when the structural imbalances became too large to hide. The mistake people make is thinking that modern financial architecture eliminates systemic risk. It doesn't. It concentrates it. What deposit insurance does, and I want to be precise here, it protects small depositors in isolated bank failures. It was never designed for systemic collapse, for a scenario where the sovereign itself is the problem. And when the sovereign is the problem, the guarantor of your insurance is the same entity that's failing.
That's the part that doesn't get said clearly enough. So let me simplify that for our audience. What you're saying is, deposit insurance is a firewall against a single building burning down, not against the whole city catching fire.
That's actually a very precise way to put it. Yes.
Okay, so walk me through something then. Because there's a version of this conversation that sounds like fear-mongering, and I want to separate the credible concern from the noise. When we look at Lebanon specifically, what did the minority of people who came out intact actually do differently? Not in hindsight. What were they doing before the doors closed?
A few things, and none of them were exotic. First, they held assets outside the domestic banking system. Real estate in other jurisdictions, dollar accounts abroad, physical assets with intrinsic value. Second, and this is underappreciated, they had income-generating skills or businesses that didn't depend on the financial system functioning normally. A doctor who can practice anywhere, a merchant with cross-border relationships. The third thing, which is more psychological than financial, is that they took the warning signals seriously before consensus did. There were signals in Lebanon years before 2019. The people who acted on them early looked overly cautious right up until they looked very, very smart.
So it's not about being paranoid. It's about acting on signals before the crowd validates them. Because by the time the crowd validates them, it's already too late to position.
That's the institutional mindset. Yes, you don't wait for confirmation. By the time something is confirmed in a crisis, the move has already happened without you.
Here's a challenge then, Victor, and I want you to sit with this one. Everything you're describing, the early movers, the people with assets abroad, the cross-border businesses, that's capital that already exists. So isn't the uncomfortable truth here that financial resilience in a collapse is really only accessible to people who already have something to protect? What does this framework actually mean for someone who's just starting to build wealth?
That's the right question to ask, and I won't dress it up. Historically, collapses have been deeply regressive. The Black Death is actually one of the rare exceptions where people at the bottom of the economic ladder gained leverage, because labor became scarce overnight. But most collapses, including modern ones, transfer wealth upward. That is a structural reality. But here's what I'd push back on. The assumption that preparation requires significant capital. It doesn't. What it requires is liquidity relative to your obligations. Someone with modest savings and no debt is structurally safer than someone with significant assets and significant leverage. The starting point isn't how much you have. It's how exposed you are when conditions tighten.
Okay, so debt is actually the vulnerability, not the asset size. That reframes it. And that connects to the 1997 Asian crisis, right? Because that entire contagion was essentially a debt denominated in someone else's currency problem. Can you unpack that for someone who's never studied it? What actually happened and why it still matters today?
So the core of it was this. Several Southeast Asian economies had borrowed heavily in US dollars, while their revenues were in local currency. Now, as long as the currency peg held, that was manageable. The moment the peg broke, and Thailand was the trigger, the math became catastrophic overnight. Your debt doubles in local currency terms, but your income doesn't. You can't pay. And what happened next is the part that applies directly to individual investors today. The institutions, the foreign creditors, didn't suffer the way ordinary citizens did. They walked away with restructured deals and discounted assets, while local populations absorbed austerity. That's not ancient history. That's the template.
Right. But here's what I want to flag. You mentioned earlier there's something in the bond market right now that's being ignored. I haven't forgotten. What is that signal?
Yes. So, and I want to be measured here because this isn't a prediction, it's an observation. What we're seeing in sovereign debt markets in several developed economies is a slow repricing of long-duration risk, meaning investors are demanding higher compensation to hold government debt for longer periods. That sounds technical, but the implication is significant. It suggests that at an institutional level, the confidence in long-run fiscal sustainability is quietly, incrementally being questioned. Not abandoned, questioned. That questioning, if it continues, is exactly the kind of slow mismatch I described at the start of this conversation. Official narratives saying one thing, markets positioning for another.
So the bond market is essentially doing what those Byzantine merchants did, noticing the gold content is slightly off before anyone's announced a change.
That's a historically accurate analogy. Yes.
Let me bring in something that I think surprises people when you study these collapses. Because the Black Death narrative we're taught is pure catastrophe. Half of Europe dies, economies collapse, but economically, for survivors, it actually created opportunity. How does that compare to what we saw in 2020? And what does it tell us about how crises redistribute rather than just destroy?
A parallel is striking. In the 14th century, the survivors of the plague found themselves in a world where land was abundant and labor was scarce, which is the exact inverse of everything that came before. Peasants could negotiate wages. They could acquire land that had previously been inaccessible. The social and economic hierarchy shifted in ways that took generations to fully play out. In 2020, the redistribution was faster and more visible. Those with liquidity bought assets at compressed prices while markets were in freefall. Those without liquidity were forced to sell or couldn't participate at all. The government printed trillions, which inflated asset prices, which predominantly benefited those who already held assets. So the mechanism was different. The outcome rhymed.
Which brings me to the risk question I think every retail investor needs to hear answered honestly. Because there's a version of this conversation that leads someone to make very aggressive moves. Liquidate everything, move offshore, stack gold, and that could genuinely harm someone's financial life more than the crisis they're trying to avoid. Where is that line?
That's critically important, and I'm glad you raised it. The historical record does not reward paranoia. It rewards calibrated preparation. The people who came out ahead weren't the ones who abandoned the system entirely, because in most collapses, the system doesn't collapse completely, it degrades. What they did was reduce their most concentrated exposures, maintain some liquidity outside their primary institution, and hold assets with intrinsic value alongside conventional ones. The risk of over-preparing is real. If you liquidate everything to buy gold, and the scenario you feared doesn't materialize on your timeline, you've paid an enormous opportunity cost. The institutional approach is to hedge, not to exit.
So the framework isn't escape the system. It's don't be fully dependent on any single point of it failing.
Precisely. Diversification across asset types, jurisdictions, and this part gets overlooked, skills. The craftsman in Renaissance Florence, who could still produce something people needed, didn't need a sophisticated portfolio. Productive capability is its own form of resilience.
Which leads me to the last question, and I want you to be direct here. When you look at the current landscape, sovereign debt levels, currency dynamics, whatever you're watching most closely, what's keeping you most alert right now as a potential trigger for the next significant wealth transfer event?
Well, I'll say what I think rather than what's comfortable to say. The concentration of sovereign debt globally, particularly in developed economies, is at levels that historically have only resolved in one of three ways: growth, default, or inflation. Growth at the scale required is unlikely given demographic trends. Outright default is politically almost impossible for major economies, which means the third path, slow, managed inflation that erodes the real value of debt over time, is the one that's most institutionally convenient and most historically consistent. That's not a crash. That's a quiet transfer, from creditors and savers to debtors and asset holders. And most retail investors are positioned as creditors without realizing it, through cash savings, bonds, pension promises denominated in nominal terms. The transfer may already be underway. The question is the pace.
And the pace is the one thing that's genuinely hard to predict.
It is, and that uncertainty is itself the signal. When the range of outcomes is this wide, concentration becomes the real risk, regardless of which direction things move. What I'd be watching specifically is whether long-duration bond yields continue their repricing, whether currency volatility in emerging markets starts to spread into unexpected places, and whether central bank credibility, which is really just another word for trust, continues to hold. Because when trust is the last pillar, and it starts to shift, it tends to shift faster than anyone's model accounted for.
Trust is the last pillar. Victor, that might be the line that stays with people long after this conversation. We've gone from Byzantine gold coins to Lebanon bank freezes to what the bond market is quietly pricing in right now. And the thread running through all of it is the same. The question is never whether the system is safe. It's whether you'll know it isn't before the door closes. Victor Hayes, this was exactly the kind of conversation this audience needs.
Thank you. It's the right time to be asking these questions.